Hello, this is Mark Wakefield. I made it to week 5 of our course. The discussion this week will delve a little more into the concept of the differences between public and private companies, review the agency that oversees the stock states, and define a couple of key terms in financing. We will also read how and will look at factors to consider before obtaining any form of capital. These are a small company with a common stock that is not traded. Their shares of stock are not publicly traded on the open market, but are held internally by a few individuals. This type of company takes the help of private investors and venture capital. One benefit is that they do not need to disclose any company information to the general public. Another interesting fact is that a private company does not need to follow any regulations issued by the Securities and Exchange Commission until they reach $10 million and more than 500 shareholders. Larger companies with publicly owned and traded stock is a public company. These are frequently listed on several of the stock exchanges. This is also referred to as trading on the open market. One advantage of a publicly traded company is that more shares. One disadvantage is that a public company has to adhere to a lot of the regulations and reporting standards as per the SEC. The Securities and Commission Exchange, or the SEC, oversees the stock market and is primarily concerned with the promoting and disclosure of the important market-related information, maintaining fair dealings, and protecting against fraud. The mission of the United States Securities and Exchange Commission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. The world of investing is fascinating and complex, and it can be very fruitful. But unlike the banking world, where deposits are guaranteed by the federal government, stocks, bonds, and other securities can lose value. There are no guarantees. The SEC works to ensure the system is safe and secure. The SEC helps ensure the companies offering up their stocks for public trading are telling the truth about their business, their stocks, their trading, and the risk involved with purchasing those stocks. Securities and Exchange Commission. In other words, they are there to protect investors. Crucial to the SEC's effectiveness in each of these areas is its enforcement authority. Each year, the SEC brings hundreds of civil enforcement actions against individuals and companies for violations of these securities and the laws. Typical infractions include insider trading, accounting fraud, and providing false or misleading information about securities and the companies that issue them. Though it is the primary overseer and regulator of the U.S. securities market, the SEC works closely with many other institutions, including Congress, other federal departments and agencies, the self-regulatory organizations, state security regulators, and various private sector organizations. In addition, the chairman of the SEC represents the agency as a member of the Financial Stability Oversight Council. Let's shift gears and take a look at a couple of terms. Interest expense is the interest charged on the remaining principal of a loan. Interest expense is a non-operating expense shown on the income statement. It represents interest payable on any borrowings, bonds, loans, convertible debts, or lines of credit. It is essentially calculated as the interest rate times the outstanding principal amount of the debt. So how does this work? Interest expense often appears as a line item on a company's balance sheet. Since there are usually differences in timing between interest accrued and the interest paid, if interest has been accrued but has not yet been paid, it would appear in the current liabilities section of the balance sheet. Conversely, if interest has been paid in advance, it would appear in the current assets section as a prepaid item. Loan costs are the expenses associated with closing a loan. So the question is, what's included in a loan cost? Costs incurred may include loan origination fees, discount points, appraisal fees, title searches, title insurance, surveys, taxes, deed recording fees, and credit report charges. Prepaid costs are those that reoccur over time, such as property taxes and other insurances. One disadvantage of a loan cost, however, is that they can be very expensive to pay up front. If you want to reduce these costs, you can ask to receive lender credits. Lender credits are money you receive from the lender to offset your loan costs. You agree to pay a higher interest rate in exchange for an upfront rebate that is applied to these costs. Poor decision-making has led to the fall of many organizations. It is important to know the overall financial health of the organization. Obtaining additional capital will impact the organization. Having to repay a large debt load can severely impact the company's cash flow. The financial management of a company must have the proper ability and training to address key financial management decisions. How to use the money, how much to use, and where to use it are matters of consultation with the finance management. Even top management leadership cannot bypass the financial management organization part of your group to decide matters relating to finance. Making the right decisions is vital to keeping the organization in good health. Financial planning, investment of funds procured, financial control, and future financial policy all are within the purview of financial management, and knowledge in these areas play an important part in making the right decision when obtaining capital. As a financial manager of a healthcare organization, it is important to know what factors to consider before obtaining any form of capital. And there are at least 4 factors to consider. First, consider the repayment terms. Consider how long the financing arrangement is structured to last. Longer loans can build up a significant amount of time. The loans with shorter terms can require larger periodic payments. Consider the amount of periodic payment and how often you're required to pay. Also take into account the allocation of each payment to principal and interest. Look for loans with a higher allocation to principal to minimize the total long-term cost. The next thing to consider would be interest and fee structures. Add up all of the costs associated with each finance method before making a decision. Common costs for loans include interest rates, origination fees, broker's fees. Financing through investment can carry many costs. Money from venture capitalists, for example, may not require repayment for years, at which time the investor may expect to be repaid at a steep premium all at once. Financing through a stock offering, though, can lead to a change in the management and a shift in strategic focus. Next, consider lending finance requirements. Consider the personal requirements each lender and investor places on the applicants. Pursue financing from sources whose requirements you meet in full. Common financing requirements include credit scores requirements and specific financial ratio tests, such as the debt to equity or interest coverage ratios. Discuss the requirements placed on applicants with each lender before preparing the loan application package. Finally, one should consider additional financing requirements. Now, thinking about financing a business through investment, look into all of the ramifications of the decisions before moving ahead. As stated, venture capitalists often require a stake in a company, which they expect you to buy back at a premium after a period of rapid growth. Before you buy the ownership stakes back, however, the investor may assert a great deal of influence on management and strategic decisions. Selling shares of stock, on the other hand, to finance a business has its own set of vital considerations, including the possibility of losing managerial control in the future and falling victim to a takeover from a larger company. Luke 12:34 reads, "For where your treasure is, there your heart will be also." Since God is the rightful owner of everything we have, this means the money we earn actually belongs to God. Practically speaking, God calls the money we accumulate on His behalf, and this is the essence of biblical stewardship. This verse serves as a good reminder for us in that if we invest for the good of our organization and commit the reward to God, He will bless us. We must commit our work to God. When our hearts are aligned with God's heart, the work we do here on earth will align with God's work. Our financial decisions will align with His purpose, and our organizations will thrive when it comes to providing health care to our communities. Thank you.